Welcome to the Explainer. Today, we're pulling back the curtain on the invisible architecture that powers the entire global economy, the international monetary system. So let's start with a classic business puzzle. A company in Japan wants to build a brand new factory over in Brazil. Now, they've got plenty of Japanese yen, but they need to pay their Brazilian workers and suppliers in Brazilian real. How does that money actually get from point A to point B, safely and efficiently? Well, the answer lies in this huge interconnected web. The global monetary system is basically the rule book, the institutions, and the markets that let us swap currencies and move money across borders. You can think of it as the essential lubricant for all international trade and investment. Okay, let's dive into the first crucial piece of this puzzle, the foreign exchange market. This is the engine room, really. It's where all the actual currency swapping happens. Now, the first thing you have to wrap your head around is just the mind-boggling scale we're talking about. The foreign exchange market isn't just big, it's absolutely colossal. Over $5 trillion are exchanged every single day. To put that into perspective for you, that is more than the entire annual economic output of most countries on Earth, and it all gets traded in just 24 hours. It's wild. To manage their money, businesses really have two key tools in their belt. The spot rate is for right-now currency conversions, kind of like swapping money at the airport, but, on a much, much bigger scale. The forward rate, though, that's where things get strategic. It's a contract that lets a company lock in an exchange rate today for a deal happening in the future, which protects them from those wild, unpredictable currency swings. But, as you can probably guess, converting all that money isn't exactly risk-free. Far from it. For any company that operates across borders, this constant exposure to shifting currency values creates three very specific types of financial risk. First up, you've got transaction exposure. This is the most direct risk. Imagine you've agreed to sell your products for, say, 1 million euros, but you won't actually get paid for another 90 days. If the value of the euro drops during that time, well, the final payment you receive will be worth less than you originally planned for. Second is what we call translation exposure. This one is more of an accounting risk, something that happens on paper. When a huge multinational company pulls all of its global financial reports together, it has to translate the value of its foreign assets, like that factory in Brazil, back into its home currency. A sudden change in the exchange rate can make a very profitable foreign subsidiary look a lot less valuable on the parent company's main balance sheet. And finally, there's economic exposure. And honestly, this is the big one. This is the long-term risk that exchange rate changes will hammer a company's future profits and its overall position in the market. For example, if your home currency becomes permanently stronger, it could make all of your exports more expensive and way less competitive for years to come. So, how did we even get here? Let's take a quick look at how the rules of this game have changed over the years. The system we have today wasn't just built overnight. It's really the result of more than a century of economic trial and, well, some pretty spectacular errors. For a long time, the world ran on the gold standard, which gave everyone a lot of stability by tying currencies directly to a fixed amount of gold. Then, after World War II, the Bretton Woods Agreement created a new order, pegging all the world's currencies to the US dollar, which was then convertible to gold. But that system blew up in the early 1970s, which kicked off the more volatile, floating era that we live in today, where market forces pretty much decide a currency's value. And this comparison really shows a huge shift in philosophy. Bretton Woods was all about discipline and stability through fixed rates. The current system? It's all about autonomy. It lets countries manage their own economies, even if that means more turbulence in the currency markets. The IMF's job completely changed too. It went from being a referee of fixed rates to being a kind of global financial firefighter. The final pillar holding this whole thing up is the global capital market. So if the foreign exchange market is the plumbing, this is the reservoir, a massive interconnected pool of money that funds international business and fuels growth. It works by connecting those who have extra capital, the investors, with those who need it, the borrowers. And right in the middle, you've got the market makers. We're talking about the big commercial and investment banks. They're the ones who facilitate this incredible flow of capital around the globe, creating what is essentially one single integrated market for money. And the benefits here are massive. For borrowers, like our Japanese company building its factory, a global market means more lenders are competing for their business, which of course drives down the cost of capital. And for investors, it offers the golden ticket, portfolio diversification. It allows them to reduce their risk by spreading their investments across many different countries and economies. But that interconnectedness is really a double-edged sword. The incredible speed at which capital can flow, what people often call hot money, can quickly destabilize smaller economies. And as we saw so dramatically in the 2008 financial crisis, when problems pop up in one major market, they can spread like a virus through the entire global system. That's the risk of contagion. So, given all of this complexity and all of this risk, how can a business actually thrive? Well, the answer really lies in having a deliberate, strategic playbook. So here are the key takeaways for any international manager. First, you absolutely have to manage your currency risks proactively using tools like those forward contracts. Second, to limit that long-term economic exposure, it's really smart to spread out your production activities across different countries. Third, you can leverage the global capital market to lower your borrowing costs, but you have to be mindful of the added currency risk. And finally, you have to recognize that your company can and probably should play a role in advocating for policies that help foster a more stable global system for everyone. This brings us to a final, really provocative thought. Our modern system is built on speed, information technology, and deregulation, all things that have fueled just incredible global growth. But they've also made the system much more fragile. So you have to ask, is another global crisis simply the inevitable price we must pay for living in such a deeply interconnected world? That's the question that central bankers and business leaders are grappling with every single day.